Hi, welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows into the conventional fund business for the week ended Wednesday, October 12, 2016. Investors took about $17.1 billion out of the conventional fund business this week. And this was in a week of kind of uncertainty. A lot of people sat on their hands. We had a lot of news coming out. We had the minutes from the federal FOMC, the Federal Reserve Board, the policymaking committee. They came out with their statement. We were taking a look and waiting for Alcoa to come out with its earnings reports, which turned out to be a little bit on the dour side. And then also we were waiting for non-farm payrolls to come out to see what maybe the Fed was going to do. Well, that actually played into really what the flows added up to be this week. Let's go ahead and take a look at our macro groups to see how that transpired and what that impacted. Macro groups said we saw equity funds lose about $3.5 billion. Taxable bond funds also had outflows about $3 billion. But muni money market funds for the 54th consecutive week actually saw inflows, this time only to the tune of about a little less than $100 million. And then we also saw that money market flows, just like we've been talking over the last several weeks, had huge outflows, $10.6 billion. So really the money market funds was the reason this was dragged down, and maybe an over-exaggerated headline flow of $17.1 billion in outflows. Well, let's take a look at equity funds to see what happened in that group. Equity funds for the second consecutive week had negative returns, about 1.47% this time. So it was quite a big decline for a 1 week period of time. Again, investors were sitting on their hands waiting for the news to come out. Alcoa came out and really sent a dour tone over the entire market. And also we had some issues with oil kind of going up and down, and some other issues going on. So really it was the reason why we had negative returns. But we saw about $3.5 billion exit the fund industry, 31st consecutive week for equity funds to lose money. So this has been a long trend. Year to date, we have $151.5 billion that have exited the fund industry out of this group. Now, if we take a look at the individual breakouts, domestic equity funds saw about $3.1 billion, 36 consecutive week they've seen outflows, and they had a negative return of 1.23%. Now, if we take a look on the non-domestic side, they also had outflows, but only to the tune of about $400 million, and ironically, they had a bigger loss, 1.94% decline in the market. And if we take a look at the individual breakouts, large cap funds saw the lion's share of money leave on the domestic side, $2.3 billion, and international equity funds saw about $600 million in outflows. Now, this is kind of crazy because then we saw the instead of the international, global actually took in money, about $200 million, and we saw emerging markets take in money, about $200 million. So a little bit of a head scratcher there. Let's take a look at what transpired on the equity ETF side. For the second week in three, we've seen inflows. This time, though, only to the tune of $136 million, so really not a lot to talk about. At the top of the group, we saw iShares Core S&P 500 take in about $600 million. iShares Core S&P 500, actually S&P total U.S. Fund market or stock market, actually took in about $500 million. At the bottom of the barrel, as we might expect when markets kind of getting tanked, we saw S&P 500 lose the biggest share, well, probably about $1.8 billion in outflows. And then we saw the iShares MSCI Edge Minimum Volatility US ETF lose money to about $700 million came out of that group. So why don't we take a look at fixed income funds to see what happened in that group. And this is one of the times where we've actually matched kind of what's been going on. Fixed income funds, people really didn't know what to do, afraid that the interest rates were going to be increased. In fact, the Fed in their minutes basically said they were going to try to get it done this year, saw that the economy is tooling along, employment's tooling along, and a lot of people are pricing in. In fact, just today we saw at least a 65% chance of the Fed raising interest rates in December from the Fed Tool Watch group. So that was one of the reasons we saw that. So again, we saw about $3 billion in outflows, second consecutive week that we've seen negative returns, 0.36% as far as returns go. And how this panned out is international and global actually took in the biggest amount of money, $194 million, so really not that big of a deal, but it's the sixth consecutive week they've taken in net new money. And then we saw at the bottom of the barrel, flexible income funds lose about $1.5 billion, and this is the seventh week in 8 that they've actually seen outflows. So people have been kind of ducking for cover from that flex or higher risk area. And then they also took money out of the corporate investment grade debt funds to the tune of about $1 billion. Interesting enough, though, if we take a look, we've seen 11 consecutive weeks that investors have been putting money to work into the loan participation or bank loan funds. And so we are seeing a trend where people are betting that in fact interest rates are going to increase. We've seen the inflows come into that area. Let's turn our attention now towards the ETF side of the fixed income universe, where we actually saw a slight inflow. About $900 million in net new money came into that group. Fourth consecutive week they've taken in money. And iShares iBoxx High Yield Corp was the big gainer, only $486 million, but certainly they took in money. And iShares TIP bond ETF took in $185 million. Makes sense. This is the same idea of the loan par, is that we have Treasury inflation protected securities actually gaining as investors worry about rising interest rates. At the bottom of the barrel, as we might expect, we saw the iShares 20 plus Treasury bond ETF lose money, about $305 million walked out of the doors of that particular ETF. Well, now let's turn our attention to the Muni Bond Fund Group. And this is really kind of a story to talk about, 54th consecutive week, but they only took in about $9 million this week. This may be the inflection point. We've had 5 weeks and 6 that we've had negative returns, and this time it was to the tune of 0.45%, so a half percentage point. And investors are probably getting a little bit worried at this point. And what makes us think that this could be a sign of an inflection point, a change in investor demand, is that we saw national munis, which has been taking in money for all 54 weeks, actually turn negative this week. Only to the tune of $6 million, so it could be a rounding error, but negative nonetheless. And so this is something that we're definitely going to keep an eye on. So the first week in 54, national munis actually lost money this week. Well, let's take a look at money market funds now. Money market fund arena has actually been a story that both Pat and I have been talking about for quite some time. Second consecutive week, we've seen outflows, $10.6 billion this time. And how it broke out was taxable money market funds saw about $9.4 billion in outflow, while tax-exempt money market funds saw about $1.2 billion in outflow. But if we take a closer look at the taxable money market side, we see institutional investors pulled about $5.4 billion out, while retail investors took about $4 billion out. Now, the real story comes in when we break out the year-to-date flows, and this actually occurred on a weekly basis, but it's more dramatic to present it to you in the year-to-date flows. Year-to-date, institutional money market funds, which would have a floating NAV as of today, it needs to be implemented today, they've seen about $609 billion in outflows, while institutional U.S. government money market funds, which will have a fixed NAV, have taken in about $471 billion. Now, on the tax-exempt side, and particularly in the institutional, but really all tax-exempt munis is what I added up here, $112 billion in outflows. Some of that money is because of the institutional, floating NAV versus a fixed NAV, but some of it is because money has been going into tax-exempt bond funds as well. So we'll have to see how that plays out. Well, if you'd like to do a deeper dive and check out some of the areas that I have not covered, you can go to our site, www.lipperusfundflows.com, or you can join us next week when one of the analysts will be talking about flows in your neck of the woods. Thanks for joining me today. My name is Tom Roseen, wishing you the best in your wealth planning and creation.